How to get rich in the stock market. Proven strategies. Many people have traveled the same path and found a golden stream of wealth that continues to enrich their fat portfolios every moment. The most well-known of these is Warren Buffett, the Oracle of Omaha, with a net worth of $72.5 billion. What intrigues me is that a whopping 84% of all stocks owned by Americans belongs to the wealthiest 10% of the population. To put a finer point on it, 38% of that 10% belongs to the top 1% richest. According to Goldman Sachs, this wealth amounts to $21.4 trillion in public and private stocks. So it's evident that the 1% rich hold a significant portion of their wealth in stocks. This tells us that stock investing plays a major role in wealth creation. But if you know nothing about investing in stocks and how to make money on Wall Street, learning tactics from experienced investors and market gurus is a shortcut to success. In today's video, you'll see the tactics and strategies seasoned investors use to get rich in the stock market, and you'll learn to avoid the mistakes that could cost you thousands and, in some cases, millions of dollars. So let's get into it. Strategy number 1, think in decades, not days. Investing is a long-term game, and industry gurus know this well. Warren Buffett says to only buy things you'd be perfectly able to hold even if the market closed for 10 years. In other words, if you want to build wealth with stocks, you need to have a long-term mindset. This requires patience and time. Charlie Munger says, "The big money isn't made in the buying or selling, it's made in the waiting." If you decide to withdraw or sell your investment immediately, or at the first sign of the market dipping down, you might have an unfortunate experience. When the market drops and stock prices start plummeting sharply, most people instinctively start selling their stocks. They're usually among the first ones to sell. Most people are easily swayed by a multitude of factors: what they see on TV, hear at parties, read in newspapers and magazines, see in newsletters, etc. And predictably, these factors convince them to buy too high or sell too low. But I don't blame them. Because if I didn't know better, I'd do the exact same thing. This is the logical course of action. If they told you a tsunami or hurricane was about to hit your home, you'd want to get out as soon as possible. The same goes for behavior. Instinctively, it's human nature to flee from danger. The same is true for a stock market crash. It would be insane to want to jump into a burning house. But let me let you in on a little secret. It's actually a good time to buy. Or put another way, to jump into the house. Warren Buffett said, "When others are greedy, simply be afraid. Be greedy only when others are fearful." But there's a caveat to be made. In some cases, it may be wiser to turn back and sell rather than stand pat or run into the fire. One way to avoid the impulse to get out too early is to invest in low-risk, steadily growing stocks when you're young and let compound interest work for you. For example, a 25-year-old can invest $10,000 in a stock. If you invest $10,000 into an index fund, assuming an 8.7% growth rate, you would have $281,307 at retirement age 65. However, if a 35-year-old invested that same $10,000 into the same investment just once, they would have $122,147 at age 65. Now let's analyze this example. After graduating, Julia takes a job paying $3,500 a month. She sets aside $1,000 a month and invests it into the same index fund with an 8.7% annual return. She's 22 years old today and plans to invest regularly every month until retirement at age 65. If she continues to invest $1,000 into an index fund, she'll become a millionaire in 25 years at age 47. If she keeps going, she'll accumulate another $4.68 million by investing $1,000 for another 18 years until reaching retirement age 65. So by age 65, the value of Julia's investment will be the astronomical figure of $5.68 million. Strategy number 2, low risk, steady growth. Once you've embraced a long-term investment strategy, the next step is selecting the stocks that will compose your portfolio. In most cases, when it comes to choosing stocks to put in a portfolio, investors are often tempted by stocks that have outperformed the market in the past. However, this is not always a wise choice. Warren Buffett puts it this way: if past history was all that was needed to play the game of money, the richest people would be librarians. Unfortunately, change, fluctuation and volatility are words that describe the nature of the stock market. Stocks that soared like eagles in recent years can turn to dust in a blink of an eye. While a stock's past performance is essential for portfolio construction, it's not wise to bet on underperforming stocks unless you can assess the investment's value well. Investing in healthily growing companies is essential if you hope to accumulate wealth over time. Aggressively growing companies can help you increase your wealth, whether in an irregular geometric series or a small arithmetic series. The most important thing, however, is that companies are always thirsty for growth. The possibility of a shocking event on Wall Street is undeniable. However, the more growth, the more stock wealth accumulates. So if you want to buy shares of these companies and are wondering how to identify them, the wrong way is to listen to Wall Street stockbrokers' alluring and seductive stories. The right way is to assess the company's growth potential as evaluated by stock analysts. This way, you can determine if the stock has growth potential. For example, stock analysts publishing research results are incentivized to be conservative in their assessments. If their estimates are high and the stock price disappoints, they could lose their jobs. If their estimates are low and the stock price exceeds expectations, they won't lose their jobs. The trend of earnings upgrades from analysts is thus an impressive signal of a company's growth. Analysts are always reluctant to upgrade earnings forecasts. Another important factor to consider is a company's sales growth. Companies that are consistently increasing the number of products sold or services offered have positive growth potential. Ultimately, this will lead to increased market share. However, be wary of companies that have increased their revenues and sales because they raised the prices of their products instead of expanding the market for their products and services. Strategy number 3, diversify your portfolio. One of the fundamental elements to keep in mind when building a stock portfolio is diversification of securities. Portfolio diversification is one of the best ways to protect your investments while also ensuring your portfolio continues to grow. No matter which stocks you invest in, their performance is not always positive. Sometimes they can underperform, and you might even incur losses. However, if your portfolio is diversified such that you're investing in, say, technology, healthcare, mining, airlines, and retail. If retail and airline stocks are underperforming, but technology, healthcare, and mining are bullish, these stocks should offset the losses, and your portfolio should continue growing. Potential losses can also be diversified and offset by investing in assets that exhibit a negative correlation with stocks. A hugely popular asset class in this category is gold, which can be traded on the derivatives market. In selecting growth stocks, these strategies can protect the portfolio from direct market risk by selecting stocks moving in opposite directions, offsetting fatal market movements. Strategy number 4, don't fall in love. Surprisingly, falling in love with stocks can actually happen. Investors tend to fall in love with stocks that pay regular dividends, go up in price, and make them a lot of money. But don't say I didn't warn you when this ends up breaking your heart. Markets are volatile, ever evolving, and fluctuating. Some days are great, others not so much. Stocks that consistently generated profits in the past doesn't necessarily mean they'll follow the same trend in the future. It's a mistake to assume a stock will always be profitable, no matter how evident it is that the stock price keeps going down. It's a mistake to fall in love with a stock. The numbers, and only the numbers, drive your investment decisions. Strategy number 5, conserve the stocks. Conservation methods are ways to protect yourself from losses, preserve profits and mitigate risk. Seasoned investors use two main methods. The first method is known as the call option. It generally involves a contract that can be purchased. Its advantage is that it gives the right, but not the obligation, to buy a certain quantity of stocks at a certain price within a certain period of time. Whenever this right is exercised by triggering a call option within a certain time period, the seller of the stocks must sell their shares at a predetermined price. By purchasing a call option, especially if you have a strong conviction that the stock price will rise in the future, you can potentially earn greater profits while preserving capital. The second method, the put option, is of a more conservative nature. The contract gives the investor the option, but not the obligation, to sell the stocks at a specific price within a set time period. Put options on stocks are often triggered during market downturns, protecting the stocks from falling below the price specified in the contract. In this case, the company has the assurance of receiving the strike price even if the stocks become worthless. Conclusions. One always needs to remember the fundamental principle that getting rich requires patience and perseverance. It's a long-term game that requires diligence, diversification, and conservation. We must never be at the mercy of hasty and immature decisions driven by emotions, but always keep the end goal in sight. Share your personal experience on today's topic with us. Write it in the comments and ask us any questions you may have. We will be happy to answer. Leave a comment so that we can perfect our creations. We will be happy with your simple like, but the most important thing is not to forget to subscribe to the channel so you don't miss the upcoming videos.